What are the chances of South Africa recovering from this economic setback? Well, to discuss this, let me bring in Mike Schussler, economist there. Mike, thank you very much indeed for your time.
Pleasure, Blaine. Nice to be with you.
It is. Thank you very much indeed for taking the opportunity. Look, the credit ratings decision made by these three rating agencies. What's your take, sir?
Well, I think it's becoming very clear that we're on a bit of a negative trajectory. They are very concerned about the increase in the government's debt to GDP. And that means they also think that it's going to become increasingly difficult for us to pay back the debt. I think we still will for the next few years, but as we start increasing it more and more,
right.
It's unlikely that we're going to be, if we carry on this trajectory, it will be unlikely that we'll walk away from this unscathed. That's the point I think they're making. And the other point is with their negative outlooks, with two of the three have got negative outlooks, it looks very likely that we'll get another downgrade within the next, say, 18 months. And that is not a nice picture for us to have. And what we've also seen is they now don't trust our debt trajectory that our government is giving them. So what Treasury says we're going to peak at 95%. The one reckons we're going to peak at 110%. I'm not quite sure of the number of the others, but it's quite clear that both of them that issued statements don't think it's going to remain under 100% debt to GDP ratio from government debt alone.
Mike, what's your take? I mean, compared to other sovereigns, does South Africa have the capacity to mitigate the shock over the medium term?
We do, but the decisions that we're going to have to make is going to be quite harsh. I think you guys at the SABC are feeling the impact of that. The SAA debacle is feeling the impact of that. We're looking at PRASA, which is not able to deliver services at the moment. And we certainly are going to have to look at government spending overall, whether it's salaries or whatever the case may be. So we can recover, but it's not an easy road. And it's hard political decisions to make to tell people there's no more money. It's been very easy money that we've had for a while, and then it became harder. And now it's going to be extremely hard doing this without any cutbacks in services, cutbacks in bailouts, all those sort of things that we've been doing for quite a while. It's going to be very difficult, and it's going to have an impact on people's lives. There's no doubt about it.
I want to talk about the impact, but I want to explore the issue of the state-owned enterprises. The financial strain to the government caused by the pandemic is one thing, but what about the continuous support to state-owned companies? What sort of impact does it have when rating agencies make their decision?
You see, the government can help state-owned enterprises in two ways. One, it can guarantee the debt, which is a little bit not as dangerous as when they start taking their money and putting it into the state-owned enterprise to help it out. And in many cases, you could say, yes, there is a case to be made. For example, just a neutral case, AXA was very hard hit during COVID. It was a profitable enterprise. Before then, it will probably become profitable again. So you could say, there are examples where the state should get involved and tie companies over. But, for example, on the other end of the scale, we have a situation where the national airline has not made money in 20 years, yet we're putting money in again. It will be restructured, certainly, but it's not going to have more than 20% of the jobs that it had before. And ultimately, at the end, we are going to pay for that as taxpayers. And that goes back to our debt pile. And I think everybody's a bit concerned the way that we're handling it and the ones that we're choosing as well. I think that's the other issue. It seems that the ones that we choose are not always the most viable. And then there are other issues as well that we have to remember. If you take, for example, our train services in South Africa, they actually bring home and take to work the poorer element of our society that is poorer parts of the working class, the people that can't afford taxi or bus fares. And in many cases now, those trains have stopped running. And, do you still put in money into that organization without trains running? Or do you regenerate it and try to get other people to run it for you, but give them the subsidy? It's going to be a lot of hard decisions where we get to now. And a lot of those decisions are going to impact on people's lives, on their careers. But it also impacts at the other end what government can provide in services, say at a hospital or at a school. And these are very, very big decisions that we have to make, and we have to make the right decisions. It has to be about who we need to help and how the country can get forward.
Of late,
we can't afford. Don't have a luxury of making luxury choices anymore.
Right. Of late, we've been hearing about these green shoots stemming from the seeds that we've been sowing. S&P has affirmed South Africa's long-term foreign and local currency debt ratings. The agency maintained a stable outlook. According to S&P, the lockdowns associated with combating the COVID-19 pandemic plunged South Africa into its sharpest quarterly economic contraction in the second quarter of 2020, leading to, a large widening of the fiscal deficit and rapid rising of government debt. Nevertheless, Mike, there are indications, they say, that the economy is beginning to rebound in the third quarter. Do you see these indications? Is it promising enough?
Look, we are going to have the highest growth that this country's ever seen in the third quarter. It is part of our bounce back. It's going to be wonderful news. It's not going to take us to the previous levels that we were before the recession hit us in the middle of last year, but it's going to take us virtually 80% back, which is a very good story indeed. And yes, there are green shoots in the economy. But we must also remember we've been spending a lot of money, government has, about 2 billion more a day than it gets in. That's what our finance ministers told us. And that has certainly helped and boosted the economy. There are clear signs of pickup in things like manufacturing, mining, retail sales. Yes, hotels are scraping off the floor, but they're still very low. Restaurants got a way to go. Air freight has a way to go. So we've got certain sectors that are going to be under pressure for quite some time to come. But there are certainly very, very good signs. The one thing we must just also say, S&P had us on the lowest rating of all three agencies. So the fact that they didn't move is maybe a bit of a sign that they think this is where we should be. Whereas Fitch has now joined S&P on that level, and Moody's is still one level above those two. And I suspect that we will still see further downgrades, but I think we're getting to the end of the downgrade cycle now, hopefully, and we can hopefully get away without becoming highly speculative grade, which would have a very big influence as well on the amount of money we will pay in interest.
The downgrade,
so we are certainly got good signs coming.
Right. So that's good news, good signs. The downgrade will not only have, immediate implications for our borrowing costs, it will also constrain our fiscal framework. But Mike, you touched on this earlier on. I want to get a sense, I want to give our viewers a sense of what can we expect in the near future, over the next couple of months. Explain the impact on ordinary citizens.
Well, first of all, most of us have now seen our jobs come back. There is a number of people that will not come back into work right now. It's approximately 1 million to 2 million people. We're not quite sure. They will be joined by new people in January, school leavers and the like. And so for the next couple of months, quarters, I still expect unemployment rates to go up. What I do, however, expect is that growth will start materializing. As I said, it will be the best growth ever in the third quarter. It will carry on in the fourth quarter, obviously not at that rate, at a slower rate. And then hopefully we get back to sort of normal by 2023, 24, where we were in 2019. Some sectors like mining might race ahead a bit, which will be great. But we need to now free up the economy, and we are on that route. We are going to see in the next couple of months more frequencies for the cell phone operators. We are going to see more things done with rail, where we'll see competition, hopefully, on our rail network. We'll see a lot of those sort of monopoly networks will find electricity, will find competition. And I think that will be good news. I also think it will help the municipalities with their finances if they generate their own electricity. So that's also another thing that we've got to look forward to.
But how
it's not going to be easy.
Right.
Many people are still going to be without work.
This is the thing, and just explain to our viewers, how will it affect them in their pockets over the next couple of months? Taking consideration there is a possibility of further downgrades.
Yeah, I think the first thing is that the majority of the poor people who get SASSA grants, that extra spending that we've seen, stops in January. We will then not see big increases in SASSA grants, not inflation related, I don't think. We will probably see very few jobs that are going to have salary increases in the next year or two, because the economy is still going to be constrained, and people are going to tread harder to stay in the same place. And it's going to be tough out there. It is. And businesses are going to have to look for new markets. It's a very new world out there. We're going to have to look at countries next to us, countries far away, wherever we can get work. We're getting tools like Zoom or so on for the services to do that too. But I think overall, for the ordinary person watching this, your salary is unlikely to beat inflation next year, your increase in your salary, that is. For the SASSA grant people, you're unlikely to get an inflation-beating increase in your SASSA grant. We'll probably see a lot fewer growth in that. I think they're going to have to constrain the people that get these grants. I think salaries at civil service and state-owned enterprises are probably going to be in one form or another cut, whether it's the whole salary bill that you cut by having fewer people work, or whether it is actual decreases in salaries for some people. And especially on the senior levels in government, we're going to see that, we hear. So we are going to see, people down buying smaller cars if they can afford cars, people looking for second incomes, I would guess. Those are the things I think the ordinary person will be doing. I think for pensioners and so on, the market hasn't performed that well either, so they are also not going to get major increases. So I think it's going to be a year or two of treading water for most people.
They say hard times make strong people, and we need strong people to create good times. Mike Schussler, Economist, appreciate your time, sir.
Thank you.
All right. There you go. That's the situation with regards to the rating agency and their decision and what it means to ordinary South Africans. Well, let's get you